very pleased to have Dr. David Kelly, Chartered Financial Analyst and Managing Director, Chief Global Strategist at JP Morgan Asset Management. And David, thanks for joining us.
Glad to be here.
And we've got just, I guess, a million questions about the market because we've had a lot of volatility lately, and a lot more so than maybe we've had in the recent past. So maybe let's just start with why do you see that there's more volatility right now than there has been?
Well, I think the real issue is that volatility had been very low all year, and what we've seen in October really wasn't that dramatic. I mean, you've got to remember we've got the Dow at these levels. If you have a 100-point day or 200-point day, that's not really a big deal. It's not that volatile. So the stock market's always somewhat volatile. It had been very calm. It's got a little bit more volatile. Why? Well, this is an old expansion. I mean, we are in the 10th year of an economic expansion, the 10th year of a bull market. People are a little bit nervous. I mean, people remember the last two big bear markets where the stock market fell by 50% and they don't want to get hurt by it. So when things come up like Brexit or trade worries, or just worries about the election or worries about future earnings, these things I think are causing a little bit of volatility right now.
You know, and you mentioned that it's a really long economic expansion at this point, and we're seeing the Federal Reserve tighten interest rates, which tends to be a late cycle phenomenon. Today, Vice Chair of the Fed comes out and says we're getting closer to neutral. How much further does the Fed have to go, and when is that going to start to really impact the economy?
Well, I think that they do need to move to neutral. I think that's okay. Now, they've actually defined neutral because in their own forecast, they say that in the long run, if they're doing everything right in monetary policy, the federal funds rate ought to be at about 3%. Now, they're right now between 2 and 2.25%. So if they raise rates when they meet in December and then raise rates in March and in June of next year, and they raise by 0.25% each time, then by June of next year, you're between 2.75 and 3%. And that's pretty much what they think is neutral. So I think that's probably where they'll stop, or at least pause. And I think there's going to be a change in market sentiment on this because the Fed themselves have said we're going to go past that. I really don't think they are. I think that if they get to neutral, that's probably okay for this economy. I think they should move to neutral, but I don't think they'll move past that.
Let's talk about the midterm elections because there was a lot of interest in it, and I think things happened as we kind of expected. But how does that potentially affect the market going forward?
Well, I think well, first of all, it was as expected, and that's important, and that's why I don't think we've seen a huge market reaction to it. I think the second thing, and a very important thing, is don't let how you feel about politics overrule how you think about investing. Just one sort of statistic I think is fascinating is that if you go back over the last 50 years, the U.S. stock market's given you about 10% per year, which is really excellent. But in the 8 years between the President Obama's election and President Trump's election, the stock market gave you over 12% per year. And in the 2 years since President Trump was elected, the stock market's given you over 15% per year. So there has been a huge bull market while President Obama was in charge, and a second bull market while President Trump was in charge. And there are an awful lot of Democrats who've missed out on the Trump rally, and Republicans who've missed out on the Obama rally. So I think it's very important not to get too obsessed with politics. The other thing I'd say is, yes, we've got divided government. That's the norm. More than 60% of the time since World War II, we've actually had divided government. But I do think it makes a difference because if the Republicans had control of everything, I think we would have seen tax reform 2.0. We would have seen more infrastructure spending. We might have seen more defense spending. I think we would have had bigger deficits. So I think divided government is going to slow down the amount of government stimulus. But actually, I don't think that's a bad thing. I think this economy is running at full employment. You don't normally give an economy at full employment stimulus. So in a way, I think this is okay that we've got divided government, that we don't see more stimulus at this point in the cycle.
From a political perspective, one of the things that's really been gyrating markets has been trade discussions.
Yes.
Does the recent election have any impact on whether or not we see continued tariff wars?
I think it does a little bit. I mean, the administration gets to make trade policy. Years ago, the Congress have more or less ceded control of trade policy to the executive, and there's no way they can take that control back. So the president does get to make trade policy. But I think he is, as we move past the midterm elections, he will focus more on 2020. And one of the problems is, remember I said we were not going to get more stimulus. I think that's true. Therefore, the economy is probably going to be slowing down a bit. And again, that's okay. I think it'll slow down to about 2% growth in the second half of next year and going into 2020. But the one thing the president wants to avoid is an actual recession. And one of the problems is that tariff wars are very damaging to the global economy. They're very damaging to the US economy. They fill the atmosphere with uncertainty. That causes investment spending to slow down. If you raise Chinese tariffs on Chinese goods, it's going to slow down consumer spending. So to some extent, I think it puts pressure on the president to try to come to a deal with China. And my instinct, and I must admit there's a lot of opinions out there on this, but I think the president actually will come to a deal with China. I think he wants to be the person who makes a deal. He will certainly portray that as being a deal that no other president could have gotten. And I don't know how that plays politically, but I think from a economic perspective and thinking about the 2020 election, I think the midterms in some ways make it even more likely that we will see some deal to try and ratchet down tensions with China. And I think that's very important.
If there is slower growth coming ahead in the next year or two, and with the lower taxes, then likely the deficit might balloon even a little bit more. And how concerned are you on that?
Well, I am concerned. I'm concerned about the deficit the way I'm concerned about global warming. I mean, I don't think that I'm going to be killed by it right now, but I think it's a bad trend and we ought to do something about it. The truth is we are at full employment. The unemployment rate in the United States is the lowest it's been since 1969. And so if you've got an economy that's healthy, it's kind of like, to me, this extra deficit spending is kind of like bringing an extra keg to the frat party at 2 a.m. It makes for a louder party, but it ultimately means a bigger hangover.
Right.
And to me, the problem with the deficit is not that it's going to blow us up; it's just going to make us poorer in the long run. It's just like in your own finances. I mean, there are people in their 50s and 60s. Should they be taking out another credit card? Should they be, borrowing more money at that point? Well, no, because they're going to need to live off that money in retirement. And 10 years out, we're going to have a debt. The national debt is going to be about 100% of GDP. And 2/3 of that debt will be owed to people overseas. And so at that point, we will be paying taxes to fund the retirement of the Germans and the Japanese rather than fund our own. So if we live beyond our means today, we will be forced to live beneath our means in the future. And I don't think that's a very responsible thing to do.
So given that the average individual doesn't have a whole lot of control over that eventual outcome, what steps can they take today to protect themselves? Because that's pretty troubling what you're laying out, the case.
Well, yes, yeah, and I think people do need to think about it from exactly that perspective. And I think the mistake that people make is they worry about the deficit. Oh, the deficit's going to blow us up. We're going to be Argentina. We're going to be Greece. And they freeze, and they don't do anything. And they actually pull back and invest, put money in cash rather than investing. Actually, to me, what it really says is, this deficit is a shake-up call and a wake-up call to people that they need to do more for themselves. I mean, all the way through to this point, the federal government has been spending more than it's taking in taxes. In the future, it's going to have to take more in taxes than it spends. Where is it going to cut spending? It's going to cut spending on older Americans and on Medicare. It has to, because that's where all the growth is. Where is it going to raise taxes? It's going to raise taxes on richer people. So if you happen to be older and richer than average, there is a target on your back. It's kind of like the scene in Jaws where Chief Brody looks out over the back and he sees the shark. He runs into the captain. He says, "We need a bigger boat." Investors need a bigger boat because this deficit is going to make it more difficult for them in the long run.
Let's talk. We haven't heard too much about Brexit lately, but let's talk about that and its potential impact on the global economy and the U.S. as well.
Yeah, I still think that Brexit is a big splash for Britain and rather a small ripple for the rest of the world. And in fact, even just in the last few days, Britain has come to a sort of a tentative agreement with the European Union. But Theresa May, the British Prime Minister, is having a terrible time selling it to her own cabinet or to her own party. And so it looks like this draft agreement will not get through the House of Commons in Britain. And that could mean that Britain leaves the European Union without a deal, which would be a disaster for Britain. It could mean another general election in Britain or another referendum, which I think would be the best outcome. Ultimately, I don't think it hurts the Europeans that much. It doesn't hurt the global economy. It's just Britain. Britain needs to trade. And Britain cannot afford to have trade barriers with its biggest trading partners, nor can Britain afford to have a hard border between Northern Ireland and the Republic of Ireland, because that could set off the troubles which have really been a problem for Britain and Ireland for 600 years. So, this is what comes of populism. I mean, I try not to be political, Republican versus Democrat. People are entitled to their opinions. But populism is basically when you shut off the left side of your brain and you just do what feels good. And Brexit felt good to a lot of angry people in Britain, but it was a terrible own goal. It's a stupid thing to do. And I just hope that they have the good sense to give themselves a chance to reconsider now that they see what's going on. And this can only harm Britain. I do hope the British Parliament gives the British people the opportunity on a do-over on whether they really wanted to do this thing, because they really shouldn't do this thing.
I liked what you said about shutting off the one side of your brain and doing what feels good in the moment, because I think that whether it's letting political views change people's views of the economy, or whether it's a bias of, hey, I want to invest in whatever's done the best lately and deviate from my long-term plan, people are so subject to that. And so looking at a couple of the trends we've seen over the last few years, do you see them continuing? And maybe starting with this year, U.S. stocks have done quite a bit better despite the volatility than international stocks. What do you think of international versus U.S.?
I would be overweight international versus U.S. I mean, right now, the U.S. accounts for 56% of global stock market capitalization. That is the biggest number we have ever seen. And I think it's too big. And if you look at overseas economies, they've got more room to grow in the long run. I mean, we're at full employment, and the working age population is not really growing very fast. There's plenty of unemployment in Europe. There's plenty of growth potential in emerging markets. European and emerging market stocks are a good deal cheaper than U.S. stocks. So are Japanese stocks. I think the dollar is too high and it'll come down over time. So logically, again, this is where you switch on the left side of your brain. Logically, international looks like it really ought to do better than U.S. over the next 5 years. I can't tell over the next year or so. I mean, nobody can. But I mean, think about what's happened. What's happened is this. It's like a marathon. You've got all these people running in a pack, and then somebody runs ahead. They become the hare. And that's the U.S. this year. Because of all this fiscal stimulus, the U.S. picked up and the rest of the world sort of slowed down. But this fiscal stimulus is mostly sugar. And the U.S. economy will slow down again, and the pack's going to catch up. And in fact, even as the Federal Reserve stops raising rates, the rest of the world, the European Central Bank is going to start raising rates, and that should bring the dollar down. So in the long run, when I look at it, I think international will beat the U.S., and I think people should make sure they are not underweight international right now, because so many Americans are.
Yeah, I think that's right, because, I mean, there tends to be such a home bias in investing. You kind of invest what you know. But speaking about U.S. investments, what about growth stocks versus value and small? Because growth stocks have been kind of the winner for a number of years here.
Yeah. They have, and I think there's a lot of momentum going on. And I think one of the things that's happened is people have moved money from actively managed funds into passively managed funds. The problem is that a lot of active fund managers look at valuations, and they were overweight value. And the problem is that every time somebody sells out of an active managed fund and moves into a passive fund, they're implicitly moving from value to growth, and I think that's really helped growth outperform. But I always like to think about this. Let's think. Don't think about the next year. Think about the next 5 years. So let's move through a cycle and a few events here. On average, overall, value stocks are a little bit cheaper than growth stocks relative to their history. And if you look at that history includes the tech bubble. So when I think about that, I think value stocks are really, significantly cheaper than growth stocks. At the moment, I think the big trend is still rates are going to rise, be overweight cyclicals versus defensives. So that's kind of how you should split the market up, rather than value versus growth. But in the long run, I do think value will beat growth. I particularly like small cap value, which tends to get left behind in this kind of market. I'd want to have a chip in every square, but if I had an extra chip, I'd put it down in small cap value.
What about, as you think more broadly to a portfolio, a lot of people, maybe they own a few international stocks, maybe they own some U.S. stocks. What about other asset classes, whether that's bonds, commodities? How should people be looking at some of those asset classes now?
Well, I think first of all, on bonds, for a long time, it has been sensible for most investors, particularly younger investors, to be overweight stocks versus bonds, because long-term interest rates are being held down very low by central banks. But we are seeing those bond deals move up. And if I'm right and the Federal Reserve just raises rates 3 more times, then today's number at, I think we've got a 10-year Treasury yield right now at 3.1%. So if we ended up at 350, you'd get hurt a little bit on that, if that's where you are by next June. But I think that's about the extent of it. So I think people should gradually be moving to a more neutral position between stocks and bonds, relative to where they'd normally be. On commodities, I think it's okay to have some exposure to commodities. I certainly wouldn't be overweight commodities, because I don't think this is a very inflation-prone global economy. And I think commodities are particularly useful when you think inflation is going to go up. But I'd have some commodities. I think I think you can look at various alternatives also within asset classes. I think you have to be very, very flexible at this point. But I think the number one thing I do is make sure that I had enough international equities versus U.S. equities.
How do you feel? Let's talk a little bit about emerging markets and China's impact on emerging market investments. What are your thoughts there?
Well, China is gradually slowing down. I have not seen any evidence of China is in crisis. I think China, of course, controls the data coming out of China very, heavily. But even talking to people on the ground in China, things are growing a little bit more slowly. But it looks like it's okay. I think the Chinese are very nervous right now about this trade war. And I think actually all of Asia is nervous about the trade war because Asia is really built on exports, and they will get hurt very badly by a trade war if it comes to pass. So I think really your opinion on how that one plays out really will have a big impact on emerging market stocks in general, because most emerging market stocks are actually in Asia. So I think it'll have a big impact on that. But overall, I am relatively optimistic because trade wars are just bad and they don't work. They never achieve the goals that they're setting out to achieve. So I don't think that we're going to be in perpetual trade war. And when we get some sort of agreement, I think that could be a signal for emerging market stocks and particularly Chinese stocks to rally.
If we step back and look more at fundamental investment principles, one thing that your firm puts out every quarter is the Guide to the Markets, which is a fantastic publication. And there's a chart that you put in there that looks at the last 4 decades or so, and it turns out that in 75% of those years or so, the stock market has ended up. But during that year, there's been a pretty significant intra-year decline, despite the eventual positive gain. Can you talk a little bit about how people should react to these periodic sell-offs and the fact that over time there's an upward momentum to the market?
Yeah, I think that's right, and I think people do tend to react out of fear whenever they see a sell-off. And of course, that gets to something you were saying earlier on about how people doing what feels good just gets them into trouble. And so, I mean, that's why the average individual investor usually doesn't get the full potential of markets, because they tend to sell to buy when they feel good and sell when they feel bad. And of course, they feel good when markets are high and they feel bad when markets are low. So I think people do need to look at the long span of history. And I think you should also look at the economy first and then look at markets. Because, for example, on international stocks so far this year, we haven't seen a big slowdown in the global economy. We haven't seen a big fall in global earnings. What we've seen is a fall in some international currencies, which I think is temporary. And we've also seen a fall in the PE ratios on some of these stocks, but that can always bounce back. So, looking at the fundamentals in the U.S., we are in the 10th year of an economic expansion. I think we will make it to an 11th year, which will make this the longest expansion since the Civil War. We've got very low unemployment, but what's really interesting is this low unemployment is not triggering the kind of inflation you'd normally see. So we're almost getting a free pass on strong growth here. And then we've got spectacular corporate profits. I mean, the first 3 quarters of this year, corporate profits were up 27%, 27%, and 32% year over year, if you look at operating earnings per share. And now I know profit growth is going to slow down, and everybody's focused on future earnings growth, but I think of a lot of current earnings now, which are pretty good. So when I look at those fundamentals, I think about a Federal Reserve that's being patient. I think about a global economy which is pretty balanced and growing okay. I think about what tax cuts have done for valuations, and they have made stocks cheaper. I think when you look at those fundamentals, you realize that this bull market in stocks is really built on fairly firm foundations. Now, I don't think stocks will give you great returns from here because, frankly, they've come a long way. But I think people should not be too worried about a big sell-off that will persist. Again, remember, you're planning for an entire retirement and maybe for your heirs. I mean, you're talking your investment plan for most people, what their real long-term investment goal should be is measured in decades, not in months or years or weeks. And so I think you should take these, sell-offs. You could always look at them, look at the fundamentals. Is that justified? But if the fundamentals don't justify the sell-off, then that's actually time to get in, not to get out. I've never seen a good long-term investment that didn't feel uncomfortable at the start. It always feels uncomfortable in the middle of a sell-off. That's usually the best time to buy.
David, this has been such good information. What any other final thoughts before we let you go?
Well, I think 2019 is going to be could be a challenging year. But I'm just going to sort of reiterate sort of the theme of what we're talking about here is just try to activate the left side of your brain. Look at the world logically. Try to put the political emotion aside and think about how things are going to play out. And try to suppress your prejudices, which cause you to stay away from international or cause you to get out of markets when markets sell off. they're good fundamentals underlying markets, and people should still be long-term investors.
Good advice. How can people find out more information about you and some of the things that you're putting out there?
Well, two things. First of all, you can go to jpmorganfunds.com and you can find our guide to the markets, which you kindly mentioned, which we put out every quarter and then we update every month. Or also, I've got a little LinkedIn blog, which I do every week, just on some thoughts on the week ahead and what's going on in markets. So anybody wants to find me on LinkedIn, it's just David Kelly at JP Morgan on LinkedIn.
So Dr. David Kelly, thank you so much for joining us. He's the Managing Director, Chief Global Strategist at JP Morgan and Chartered Financial Analyst, a very smart guy, as we just heard. So thank you again so much.
Anytime.